All right, everyone. Hello. In this video, we're going to talk about a very important topic. I mean, I keep repeating the same word, important, because since we've gotten into the advanced stuff, everything that is coming your way is important. So you cannot rule out any single one of them. Keep that in mind. Every single thing that we're talking about since we move forward from the basics, every single thing that we've been talking about is extremely important. You cannot rule out a single one of them. Okay, so today we're going to talk about, in this video, we're talking about momentum and market structure. First of all, let's talk about momentum. You all must be aware of what actually momentum is. It's not E is equal to mc square, like Einstein said, but momentum is also very important in the markets. The reason why, because what you're looking at, the data that you're looking at in the market to analyze, to get in on a trade, that data is basically the past receipts of what the bigger players have been doing in the markets, right? So let's say euro dollar is in an uptrend, right? Think of it as a product. Euro dollar is not a currency pair. Think of it as a product. Let's say Louis Vuitton, a bag of Louis Vuitton, right? So the price was at around. Okay, let's say that the price of Louis Vuitton bag, some recent bag that came out, the price is, let's say, $10, just for the sake of argument, right? It's never going to be $10. We all know how expensive these brands are, but just for the sake of an argument, it's $10. The price is $10. Now, the women or men who are interested in getting that new bag of Louis Vuitton, it's a status symbol, it's whatever. They're interested in buying the bag, and the product that came out for $10 was only 100 pieces, right? It was only 100 pieces for $10 each piece, and people just storm in to buy the Louis Vuitton bag. So the store sells 50 in a matter of 5 minutes. Now, if you go straight, please focus on what I'm talking about. It's going to make sense as we move forward. Okay, the store was able to sell 50 at $10, but as they saw the amount of people that was rushing in to the store to buy the Louis Vuitton bag, they were a lot more than the remaining 50, right? So the demand has increased, but there's lesser supply. So the Louis Vuitton company, the brand, it raises the price to $20. It raises the price to $20, and the remaining 50 bags got sold out at $20 within a matter of minutes. Okay, let's repeat it one more time. Louis Vuitton introduces a bag for $10 per piece. They make 100 pieces of that bag, 50 of what were sold within 5 minutes. As they saw the interest of people developing in the bag, the amount of people that were rushing in the store to get the bag, to buy the bag because it's Louis Vuitton, they kept increasing. So the demand increases, supply decreases, and the price, they raised the price to $20. Now, the remaining 50 bags were sold out for $20. And when the next order of 100 bags comes out to the market as it's available, what price do you think it's going to be at? Is it going to be at $10? Is it going to be at $20? Is it going to be higher than $20? Okay, so there's a 0% chance that it's going to come out at $10, right? And then there's a 50% chance that it's going to come out at $20. Now, you saw the price jump from $10 to $20. It's a big increase, a big jump. And if it comes out at $20, what are you thinking? The new merchandise that comes out, is at $20, what are you thinking? That I should buy it right now? Because the last time when they introduced the price at $10, previously, the past receipts of Louis Vuitton bags, when they were at $10, it increased to $20 in a matter of minutes. So what I saw in the past, looking at the past receipts of Louis Vuitton bags, I can come to a conclusion that there's a fair chance that the price is not going to remain at $20. It's going to go higher, right? So this is exactly how we look at the momentum on the markets. There is more to it, and we're going to talk about that too. Okay, let's talk about the theory first, then we'll go into the charts and we will discuss it on the charts. You might get a little overwhelmed with whatever we're talking about, because I understand that's a lot of information coming your way, but that is the reason why we're taking a little bit of time putting in these videos, so that everything that we send to you guys is, more or less, if not exactly, as less confusing as possible. Okay, so again, let's talk about Louis Vuitton. Started with $10, went to $20, and then it went up to $25, right? 10 to 20, and then to 25. Okay, all right. So as a lot of people have already bought the product of Louis Vuitton, and not as much people are interested in buying it anymore because the prices have gone up too high. That is $25 per piece. Started off with $10 and went up to $25 per piece, right? So the first jump that we're talking about is of $10. The second jump that we're talking about is of $5. So you can see the decrease. The decrease in momentum, right? Initially, you saw an increase in the momentum, and then with the second jump in the price, you saw a decrease in the momentum. It still went higher, but there was a decrease in the momentum, right? Now, looking at all of this, the first jump was $10. The second jump was $5. Maybe there is going to be another jump for, let's say, $3. But looking at how it's been behaving in the past, can you not come up to a basic conclusion of there might not be another jump, because the increment in price has slowed down, the momentum in the increment in price has slowed down. It might not go higher. It might start to come lower as the supply increases. The prices have gone way higher. As the supply increases, the demand at this higher price starts to decrease, and the price of Louis Vuitton bags starts to pull back, right? From $25 comes down to, let's say, $23, because the demand has decreased and the supply has increased, right? So they decrease the price by $2, and the pullback starts to come in, right? Goes to 23, then it goes up to 24, jumps down to, let's say, 20, goes up again to around 22, and then drops down to $15. Okay, so focus. What I'm talking about here is that the first jump was too high, $10, right? The second jump was $5, still considerably high, but not as high as the first jump. And then the price starts to come down. But how much does it come down? From $25 goes to $23. It's not even equal to the second jump that it made. What does that mean in terms of price momentum? It means that the momentum is still with the buy side, but a discount is coming in, or what we like to call is a pullback, right? A discount is coming in. The momentum is still with the buy side because the increment in the prices have still been more than the increment, than the decrease in prices. So it goes up to 24, comes down to 20. The momentum is still with the buy side, goes up to 22, comes down to 15. the momentum overall, if you take a look at how it jumped from 10 to 25, the momentum is still with the buy side. Unless, of course, it just crashes down to $5. Let's say, for example, crashes down to $5. That would, to some extent, mean that the momentum is shifting towards the sell side now. But as long as the decrease it remains lesser than how rapidly it increased, the common sense dictates that the momentum is with the buy side, right? Okay, now what we're going to do is we're going to go to the charts and we're going to discuss momentum in terms of what we've talked about right here. Okay, let's go to the charts and then discuss the momentum in terms of what we've talked about. Okay, here we go. All right. Okay, so I basically, yeah, let's just talk about this. It's one of the trades that I took on Thursday. I couldn't make as much money as I could have. I'll explain a little bit of that too, but let's take a look at this. Okay, so let's say this is Louis Vuitton bag, right? That we just discussed. This is a Louis Vuitton bag. This is the price right around here is $20, and the price just shot down all the way to $3. Oh, 3 is too less. Let's say $9, right? This is here $20. The price jumps down to $9, and I'm sorry. Give me a minute. Okay, the price drops down to $9, but how does it drop down? That is the question. So if you let's consider these candles daily candles, right? Let us consider that these candles are daily candles. How long did it take for euro dollar or Louis Vuitton to jump down from $20 to $9? 1, 2, 3, 4, let's say 5 days. In a matter of 5 days, the Louis Vuitton bag from $20 jumped down to $9. And as it's, come down so much, it starts to pull back. The price starts to go higher. The reason why, because as it dropped down so quickly, people rushed in to buy the Louis Vuitton bag. And the store basically figured out that, okay, now that the prices have dropped down so low, people are coming in to buy it, right? So they start to raise the prices a little bit. Let's just get over with these. Okay, they start to raise the prices by a little bit. The price goes up to, let's say, $13, $12, $13, and then all of a sudden people stop buying it, and then they have to drop it down to $9, $10 again, right? I understand it can be a little confusing, but we're going to put it all together, okay? I'm getting to where I want to be, okay? So it's going to make sense. Just hold your horses. Okay, so it drops down to $10, and then from $10, as people saw that the prices are pretty low now, they start to buy again. The demand increases, the supply decreases, and the prices start to go higher again. Okay. At this, where did we say the price was? $13. Okay, $13. The price goes higher. $14, $15, $16, $17, $18, $19, $20, $21. Okay. Now, the thing to notice here is that from $20 to $9, it took 5 days for the price to drop down. How long does it take the price to get up to $20 or $21 again? It's going to be a little hectic, but let's count. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. Oh, that's a lot of candles. 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43. Let's put it down to 43. So for the price that took 5 days to drop $11, it took the same product 43 days to get back to the same price. Where do you think the momentum lies in this? Obviously with the sell side, right? 5 days to go all the way down there, 43 days to come all the way up there, right? Now, as it takes so many days for it to come up, you can, clearly come to a conclusion that the trend is still down. Because if it had taken 5 days for it to come back up, then of course the momentum would have been equal, right? But it took 43 days for the same product to gain back to the same price. That clearly means that the product is gonna, the price is gonna drop again. Okay, just keep this piece in mind for now, right? And then we'll come to the next part of the video, that is break of structure, how the structure indicates where the market is going to go. And we're going to talk about the same example. Okay, let's do a quick buy example, and then we will get to the next topic of the video. It's already 16 minutes, but as I told you guys before, it's going to take a while for you to understand all of this stuff, and I'm trying to keep them as short as possible, so bear with me. Okay, let us talk about a quick buy example of let's keep the same Louis Vuitton, right? Let's keep the same Louis Vuitton bag. Okay, all right. Now we can see to the left side that, let's say, this is $9, and then this is $30. The price when it was at $9 initially, it took off, went up to $30. Supply decreased, demand increased, blah blah blah. We all know that, right? Now the market starts to pull back, aggressive pullbacks. Still, buy goes all the way up to their aggressive pullbacks. The seller still looks to be in momentum, because if you take a look at this to this, obviously this has taken less time to go all the way there. This has taken more time to go all the way up there. And then again, less time to come all the way down here, pulling back, pulling back, pulling back. The last bit of aggressive sell happens, and then the buyer takes over. Now, this buyer, let's say the price came down to $9, and the last time the price came down to $9, it went up to $30. But this time, it just goes through different thresholds and goes up to let's say $15, $16, or $17, right? Okay, now looking at the past receipts of US dollar CAD or the Louis Vuitton bag, we know that the last time prices came down to $9, they instantly, very fastly, they jumped up to $30. Of course, you couldn't grab it down at $9 at this point because it was just falling down. But as from $9 jumps up to $17, that is when you start to get interested. Okay, the last time the prices with momentum to the buy side went up to $30. There's a very fair chance that as it's jumped up to $17 now, it's going to make its way back up to $30. Okay, from $9 to $17. Let's remove all of this. From $9 to $17. Again, let's consider these candles at days. How long does it take for the price to go up to $17? 1, 2, 3, 4, 5, 6, 7. Done. In 7 days, it goes from $9 to $17. And then let's say this is somewhere in between 9 and 17. So we're going to call it $13 or $12, right? But how long does it take the price to come down to $12? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Oh, 19. So more than double the time it took from going from here to here takes more than double the time to go all the way down to there. Sorry, guys, I was just receiving a call. Okay, it goes 19 days to go all the way down to there. And then, of course, we can figure out that um, the momentum is towards the buy side. Okay. Now, as we've established the fact about momentum, how do we figure out the momentum? It's pretty clear on the charts, looking at the past receipts and blah, blah, blah. Okay, so what I'm going to do is we started with market structure. I'm sorry, we started with momentum plus market structure, but I'm going to keep this video only about the momentum, and then we'll take it from here again and talk about the structure in the next video, combining it with the momentum. Okay, so stay tuned. Cheers.